I think we're going to have this huge move where silver probably does get to 200, 300, 400, and gold, is up 7,000, 10,000. I don't really want to wait 20 or 30 years for it to fully play out. And also on top of that, we could see silver pull back. I still think silver could fall to 50. The chart actually shows, the momentum chart shows it falling down into like $30 or so. A lot of potential downsides still in the price action. If we take a look at the silver chart, I kind of put both of these up. So the top one is the weekly chart of SLV, so more or less the price of silver. Silver has kind of pulled back a little bit and traded sideways. There's a couple more bars here. But look what happened in 2011. We did the same. So like subscribers and I, we got out at silver at 113. We got out at gold at 550, 200 and change. And then the markets went, for a little bit of a nosedive. And now the market's trying to figure out what to do. I'm not looking to hold gold for 20, 30 years. I want to catch these big cycles. Like now I'm kind of unloading. I've unloaded my metals and I'm going to wait for a new launch pad or for a sharp pullback and I can just get back in. If silver breaks 106, it's going to spike to 120 or higher and it's going to be a blow off top. And that was happening, which was pretty amazing, breaking 106 while I was there. And I was talking about how we're looking to lock in profits. We're in euphoric phase for a very sharp pullback. When it becomes a mass psychology play, everybody seems to be piling in. It's usually when you want to be locking in profits. And I did a panel with David Rosenberg. And so Daniela asked us a question and I went through the technicals of what all the markets are saying and the money flows between various asset classes from a technical standpoint. And then when David he spoke after, he's like, yeah, I agree 100% with Chris. And then he's like, this is why some of this stuff was happening. He goes into the whole macro stuff, which was great. So, and him and I were both like, don't be buying here. Get ready. There's a haircut coming. And it's interesting because I did talk to some other investors there. Some people who literally were buying that day as silver was blasting through 106 and spiking up. There was the first time they've ever bought silver and they were really excited. Mm-hmm. That's usually a little bit of a warning sign.
Yeah.
When first-time buyers rush in at breakout levels, that's rarely the beginning of a move. It's usually the late innings. Chris Vermeulen highlights the 106 breakout as a psychological tipping point, not just a technical one. Historically, blow-off tops in commodities often follow 20 to 30% vertical extensions above moving averages, and that kind of stretch invites sharp mean reversion. When even seasoned macro voices warn of a haircut, it signals risk-reward is skewed. For disciplined investors, protecting capital during euphoric spikes matters more than chasing headlines. And what Chris Vermeulen implies next reframes how to handle parabolic markets.
What kind of investment, wisdom would you give to someone? So when people see like these parabolic moves, they typically get the urge to like FOMO. They're fearing of missing out. They go and buy at those levels.
Yeah.
Obviously, some people may have a longer term time frame. I was actually talking with my coin dealer, and he mentioned that a lady came in and bought 200 ounces of silver when silver was I think he sold it to her at spot when it was like 117. And then she gave him a check, and the check, he said he was going to cash on Monday. And so silver had failed to like 70, 80 bucks. And then he gave her a call. It's like, hey, I'm cashing a check. I'm sorry, And she wasn't necessarily concerned because I guess she had like a longer term outlook on it.
Right. Yeah.
But, people typically FOMO into these assets. And so I'm curious in your perspective on how to resist that urge.
It's tough. I mean, it's human nature to not feel like you're being left behind when it's more painful. It's psychologically more painful to be left behind, to miss out on gains than it is to actually hold on to a loss. There's all kinds of studies that show that.
The real danger isn't volatility. It's emotional decision-making at the worst possible moment. Chris Vermeulen underscores how FOMO overrides discipline. And behavioral finance backs this up. Loss aversion and herd bias consistently push retail investors to buy peaks. In past commodity surges, late cycle buyers often endured 40 to 60% drawdowns within months. A long-term outlook can justify conviction, but timing still affects compounding and liquidity flexibility. Investors must separate belief in the asset from entry strategy. What Chris Vermeulen suggests next reveals how to structure discipline in emotional markets.
So it's a very difficult thing to overcome. You really do need to, you kind of need somebody to, who talks about it and who knows what you're feeling and be like, this is normal. This is a euphoric phase. Yes, you may feel like you're being left behind, but this will fizzle out and you'll be glad you didn't just jump in because emotions sucked you into the trade. You wait until it like digests. Wait for a pause. Like I'm still very, very bullish on gold and silver. I think they're going to go dramatically higher over the next 5-10 years. It's going to be, who knows where they're going to be. It's going to be ludicrous probably, but it's not going to be a straight ride. There could be years where it doesn't go anywhere. I think it really comes down to having strategy, saying, okay, I'm not going to buy into euphoric kind of blow off moves. I'll wait and let them, pull back and trade sideways for a while, build a bullish pattern, build a launch pad or a base for when it starts to run and break out of that to the upside. You can jump on then. I don't have problems buying something at a higher price if it's actually leaving the station and starting another big leg up. But I don't want to hold on to it for a year or two when it might not go anywhere or it could continue to pull back.
Long-term bullish doesn't mean short-term blind. Chris Vermeulen separates structural optimism from tactical execution, and that distinction protects portfolios. Commodities historically move in multi-year cycles with extended consolidation phases. Gold, for example, went nearly 7 years between 2011 and 2018 without new highs. Buying strength after a base is different from chasing vertical spikes. Waiting for digestion phases improves probability and reduces drawdown risk. Investors focused on compounding, not adrenaline, understand patience is a position. And what Chris Vermeulen outlines next shows why volatility can reset leadership fast.
And silver pulled back. I don't know if it was the biggest silver pullback ever in a 24-hour period. I mean, it was like 42%, and margin calls like were through the roof. So there's definitely a lot of pain, but it comes down to having a strategy and just realizing you don't want to chase things, but it's tough. It is really tough. You kind of need a support system in place to not get sucked into the vacuum of wanting to buy it up.
Yeah, I was able to. I had pulled the trigger and sold some that week. I think it was actually the day before the big drop, a couple days before the big drop. Nice. I think it was that Wednesday. And I sold some physical silver. I think they weren't like, because the smelters or the refiners and all of that, they weren't accepting a lot of silver. So a lot of the dealers weren't offering the top price. Right, so I think I sold it for like 108. And then, a couple days later it drops. And I was like, okay, I'm glad I did that. And so I've been kind of accumulating a little more since then.
A 42% drop in 24 hours isn't volatility. It's leverage unwinding. Chris Vermeulen's timing highlights a critical truth. Margin amplifies both greed and panic. When forced liquidations hit, fundamentals don't matter. Liquidity does. We saw similar cascades in March 2020, when cross-asset selling crushed even safe havens. Physical markets tightening while paper prices collapse reveals structural stress beneath the surface. Strategic selling into strength creates optionality when others are trapped. And as Chris Vermeulen suggests, the real opportunity often appears after forced sellers clear out.
We did the same. So like subscribers and I, we got out at silver at 113. We got out at gold at 550, 200 and change. And then the markets went, for a little bit of a nosedive, and now the market's trying to figure out what to do. But I mean, I think the fact that you can sell into a euphoric phase that shows you have discipline. It shows you've got like logic. I mean, logic isn't always the best. It's not the fun way, right? But it's sometimes the best way, like following logic and rules. Emotions usually blur the lines and you end up holding on to things. So I mean, it's a really good sign that you're able to sell into that pressure. I know a lot of people were like, no way I'm selling. Like, this is on a roll. I'm like, okay, but you do need to lock in profits at some point. I mean, I'm more of an active investor. I'm not looking to hold gold for 20, 30 years. I want to catch these big cycles. The last time I accumulated gold and silver was 2019 when it broke into a new bull market after like a 7-8 year pause. And then we added more on the COVID dip. But other than that, like now I'm kind of unloading. I've unloaded my metals, and I'm going to wait for a new launch pad or for a sharp pullback, and I can just get back in.
Selling into euphoria feels wrong in the moment, but historically, it's where disciplined investors outperform. As Chris Vermeulen emphasizes here, cycle investing isn't about loving an asset. It's about respecting momentum exhaustion. Gold's 2019 breakout, after a 7-year base and the 2020 COVID liquidity spike, were textbook accumulation windows, but parabolic phases often retrace 20 to 35% before stabilizing. Active rotation protects capital, especially when real yields shift or Fed policy tightens. Locking gains during emotional extremes isn't pessimism. It's risk management that preserves optionality. And what Chris Vermeulen outlines next reframes why waiting for a launch pad may matter more than chasing headlines.
Just because I've seen the metal space go sideways for a decade at a time to hit all-time highs again, that's a long time.
Yeah, for sure. Yeah, I was actually, I typically try not to go back and forth with these with some of these folks on X, but someone was like, I had made the point that there's a lot of like where there's some very highly emotional silver bugs out there, and so I made this point, and the guy's just proving my point. Like, he's coming at me. You see the macro case and everything. He says about a book length of a tweet to me, replied to me, explaining all the macro. And I'm just like, dude, like I already know this stuff. And,
everybody's got their own beliefs and strategy, like, right? Like, naturally, you're gonna pull in people who have the same beliefs and time horizon that you're focusing on. People who have these crazy, they like to attack you with how wrong you are. They have a totally different belief. They believe on what price moves, like what moves price. They have a different time horizon, and they think I'm wrong. And really, I mean, I just have a different time frame. I mean, we can both. I could make money on a pullback, and if he just and then get back in later, and he could just buy and hold it.
The loudest macro thesis online often ignores the brutal math of time. Chris Vermeulen points out that metals can move sideways for a decade, and history backs that up, with silver taking nearly 9 years after 2011 to approach prior highs. Opportunity cost matters. Capital tied up during flat cycles misses gains elsewhere, especially when the S&P 500 compounded strongly between 2013 and 2021. Different time horizons create different truths, but that doesn't make one reckless and the other wrong. Portfolio construction depends on liquidity needs, risk tolerance, and re-entry discipline. Next, Chris Vermeulen highlights why sentiment extremes can distort even the strongest macro case.
We can both win. It's just a matter of how do we navigate the storms in between. But
this guy, it was kind of interesting because like he was like, we agreed on the same thing, but he was, making it sound like, oh, put up your argument against it. I'm like, well, I'm not here to argue against it. I'm saying that some silver bugs are highly emotional and need to go to counseling, right?
Yeah.
And and then he says, oh, well, see, we're up another 4%. That proves the thesis. This was the day before the drop.
Yeah.
So then the day after, I was like, should I check up on him? I was like, nah, I'm not even going. I'm not going to open any wound, pour salt on any wounds, or add insult to injury. Yeah, but it just kind of showed like some of the sentiment around when these big.
It's extreme. I really don't read too many comments because there's just a million people out there that don't see it the way that I see it, and they love to. It's so easy to be sharp and rude online, right? It's just
for sure.
I don't need to deal with that.
A 4% pop is not a thesis. It's noise dressed up as conviction. As Chris Vermeulen stresses here, short-term price spikes often precede sharp reversals, especially in volatile assets like silver that can swing 5 to 10% in days. One green session doesn't validate a macro narrative any more than one red day disproves it. Emotional anchoring to daily moves is how retail investors get trapped near local tops. The real test is how price behaves around prior resistance and liquidity events, not comment section applause. And what Chris Vermeulen reveals next shows why sentiment extremes often signal risk, not strength.
In fact, we can go to silver. I'll show you some interesting silver charts as well. if we take a look at the silver chart, I kind of put both of these up. So the top one is the weekly chart of SLV, so more or less the price of silver. And we can see this pullback that we had. Now this is silver has kind of pulled back a little bit and traded sideways. There's a couple more bars here. But look what happened in 2011. The run-ups, the pauses, and these little hiccups are almost the same in terms of price action. And then a huge 30+% pullback both times. And then we could see silver move up potentially. And then who knows? And then it goes off into a cliff. This was 2011. This is where we went into a 15-year pause in price, right? So this is what I'm talking about. It doesn't matter what the news is. Everybody says this time is different, and they are right. Every time it is different. There's different news, a different scenario, different economic climate, but price does the exact same thing. Price is driven by emotions, and emotions really drive the price action. And so we see these chart patterns. That's why chart patterns are so powerful. They tell us what people are thinking and feeling and shows us what they are doing with their money.
When price action mirrors 2011, ignoring history becomes expensive. Chris Vermeulen draws attention to the weekly SLV pattern because the 2011 peak led to a 30% plus drop and nearly a decade of stagnation. Chart symmetry doesn't guarantee repetition, but behavioral cycles repeat as liquidity tightens and speculative excess fades. In 2011, silver collapsed as margin requirements rose and risk appetite shifted, not because the macro story vanished overnight. Patterns reflect positioning, leverage, and crowd psychology more than headlines ever will. What Chris Vermeulen suggests next may challenge anyone assuming this time automatically overrides structure.
And so this is, one way to look at it. We could see, silver maybe have peaked in gold and we go into a multi-year. It's not what anybody wants to hear, but that is one scenario that we need to be aware of. And if it was to go sideways for 5, 10, or 15 years again, do you really want to hold it, right? Especially if you could buy it back potentially way lower than where it is right now. I still think silver could fall to 50. The chart actually shows, the momentum chart shows it falling down into like $30 or so. There's a lot of potential downsides still in the price action. And here's the monthly chart of silver. Now I like to use the linear chart, which is the scale, so it's based on dollars. Linear chart amplify the later stage moves, which give you these parabolic moves. They show you the emotions more or less in the market. And I want to be able to read people's emotions, because when emotions are strong, you usually want to be doing the exact opposite of everybody else. And so I really like this. A lot of people in this space use a log scale. And the log scale is a very different, you hear all these people talking about, we got this massive 45-year cup and handle. The breakout has just begun. This is just the beginning. And they totally could be true, but this is a 45-year chart pattern.
A 45-year breakout sounds powerful until you realize your capital may sit idle for a decade. As Chris Vermeulen explains, time risk is just as real as price risk, especially if silver revisits $30 after trading multiples above that. Sideways periods after peaks aren't rare. Post-2011, silver stagnated for years while equities compounded strongly. Linear charts expose emotional spikes that log charts can smooth over, and smoothing volatility often hides distribution phases. Investors chasing structural narratives must ask whether momentum, liquidity, and real rates support that thesis today, not decades from now. What Chris Vermeulen outlines next challenges whether patience or positioning matters more in this cycle.
I don't really want to wait 20 or 30 years for it to fully play out. And also on top of that, we could see silver pull back, over to, pull back here for a while. It could pull back, and it still could take another 3 or 5 years to get back to these highs before it starts the next run up. And so one chart pattern in one view, if you're really bullish in the space, everybody's looking at this because it points to the start of a 45-year pattern playing out, and it's saying buy, buy, buy. And then when you look at the linear chart, it's just a giant spike and it's saying sell, sell, sell. So it really depends on the lens you look at the markets through, right? And that's what a lot of, this is the problem with reading a lot of research and jumping from one analyst to another. They all have their own lens, and you're funneled to look through their lens. I look at the markets as raw and pure and unbiased as possible. I want to show what price is saying, what it means typically, what it's done in the past, and just trade based off that. Not that the currencies are going to fail, they all do, that the world's falling apart, but that's also probably why we have this spike in precious metals, is people are already buying into that.
The same chart can scream buy or sell, depending on who's presenting it. Chris Vermeulen highlights a critical truth. Lens bias shapes conviction more than data does. A 3 to 5 year recovery window after a pullback isn't trivial. That's an entire market cycle, possibly spanning multiple Fed meetings and election cycles. If silver retraces deeply while equities rotate into growth or AI-driven earnings expansion, opportunity cost compounds quietly. Investors need alignment between time horizon and capital needs, not just alignment with a compelling narrative. Next, Chris Vermeulen addresses why emotional macro fears may already be priced in.
We already know everything is falling apart. People don't trust anything anymore, and the government says everything is just unbelievably corrupt and convoluted. And that's why we have these big moves, I think, in precious metals. And so that's kind of my take on the two metals there.
Could we look at so 2008? I think silver fell from, I think it was $20 something to about $9, somewhere around there, right there.
Yeah.
So it's a huge drop.
Yeah, it was 60-something%. Yeah.
And then how long did it take to rally to the new highs after that? I think it took, what, 3 years?
So that was March 2008. It eventually broke out September 2010. So it took a couple years, and then it took off and had the big 2011 peak before it went into a 15-year pause in price. So, I mean, I think we could be very much so in this 2008 scenario. I don't think we're in the 2011 or we're going to have a 10-year, 15-year pause. I think we're going to have a very sharp, another leg down in gold, another leg down in silver. Equities are going to sell off. And then I think we're going to have this huge move where silver probably does get to 200, 300, 400, and gold, is up 7,000, 10,000.
Fear narratives feel convincing, right before forced liquidations begin. As Chris Vermeulen notes, silver's 60% collapse in 2008 wasn't prevented by distrust in government or bullish macro stories. Liquidity shocks override ideology, and when equities fall, margin calls don't discriminate between safe havens and risk assets. The 3-year recovery into 2011 came only after extreme washouts and policy resets. Betting on $300 silver without preparing for a deep interim drawdown is speculation, not strategy. What Chris Vermeulen implies next may determine whether investors survive the drop before chasing the surge.
I don't know. I think we could see those moves actually happen. And I think it could happen fairly quick, but I do think we could still see gold down another 20, 30%. We could see silver down another 40, 60%. And those are pretty big haircuts. And so I'm hoping to be able to pick them up at a lower price, closer to a stage where, it's going to be starting another rally. I just don't want to get stuck, obviously, in limbo. I have gold. Gold is trying to hold its ground. It's kind of running up here. And we'll see if it can eventually build a base. If we were to just zoom out on the gold chart, I mean, we've seen gold go through these series of rallies and pauses. It rallies, pause, rally, pause, rally. Obviously, the volatility is getting bigger each time, and that's where it kind of is right now. It definitely does feel like this type of pullback that we had feels a little bit different than these other ones. A lot more damage was kind of done to the chart. Sentiment was much more extreme here than it was at any of these other ones. Are we going to get one more huge blow-off move? Maybe gold 6,000 and change and silver, 140 maybe. It's possible. And it'll be another parabolic move.
A 40 to 60% drawdown isn't a footnote, it's portfolio altering. Chris Vermeulen is outlining asymmetric risk, Upside projections grab headlines, but downside volatility determines survival. Gold's prior cycles show expanding swings, and widening ranges often precede distribution phases, rather than steady advances. If real yields rise or liquidity tightens, metals can retrace sharply before any parabolic extension. Position sizing, not price targets, becomes the decisive factor in whether investors can redeploy capital near the next base. And what Chris Vermeulen signals next about technical breakdowns reframes whether momentum is already weakening.
So we just have to kind of wait to see how that's going to unfold. And, when you zoom back on the charts, if we take a look at the monthly chart here, when you look at these chart patterns, you get these big parabolic moves. And I like when we get these parabolic moves. They're difficult to trade because you don't know where the peak will be. They're bubbles. They're kind of a bubble phase, and technicals at some point go out the window. So the technicals more or less have kind of gone out the window once we hit 5,200, which is why I talked about how once we break 5,200 in gold, expect some spike and some huge emotional wave of people piling in, because it's like an emotional tipping point where the charts aren't really pointing any higher, and it'll just be emotion driven. And that's what we saw. We saw it go all the way up to almost 5,600, and then it's pulled back all the way down to 4,400, and now it's kind of bounced back up to about this 5,000 mark. So it's flirting around 5,000 on the daily chart here.
When technicals go out the window, emotion usually walks in with leverage. Chris Vermeulen points to 5,200 as a tipping point, because parabolic phases often detach from fundamentals and liquidity realities. The surge toward 5,600 followed by a swift drop to 4,400 shows how quickly speculative flows reverse. In past cycles, similar blowoffs preceded extended consolidations or sharp corrections once momentum cracked. Investors who mistake emotional spikes for structural breakouts often become late buyers, financing early sellers.